Good morning. This is Kim, your instructor, and I want to speak with you a bit about home buying. Significant purchase in your life will be a home sometime in the future. At least I hope so if that's what you want. So, in order to prepare for buying a home, I think there's a few important things that you should know. First of all, I want to talk with you about costs associated with buy a house that you do not normally think about. Here is a list of these costs. For example, the down payment. How much are you going to put down in cash up front so that you can secure a mortgage and actually have some equity built into your house? And typically, the down payment requirement is 20%. However, there are some types of loans that allow you to secure a mortgage without 20% down. But let me just give you an example over here. Let's say your first home costs $200,000. That's the price you agree to buy the house. Again, that down payment at 20% would be $40,000. $40,000. That's a lot. And that amount is required up front. So you would have to save $40,000, hopefully in your Roth IRA, in preparation to buy this $200,000 house. And then when you subtract off the $40,000, your actual loan amount is $160,000. So that's what you would go to finance through a mortgage. All right, the next cost besides down payment is something called PMI. Private mortgage insurance is required if you put down less than 20% on your home purchase. So let's say you only have a down payment requirement of 10%. So if it was 10%, given this example over here, 10% would be $20,000. But for a lender's looking at that and saying, hey, you don't have that much stake in the game here with this mortgage, and we're uncomfortable financing 90% of a house. So instead, we're gonna buy insurance. So like we talked about risk, this is a risk to the lender, and the lender doesn't want to take on all that risk. So they're going to force you, the home buyer, to purchase insurance. And what that insurance protects the mortgage lender from is default. You don't have enough money, you could, if something happened, you might consider walking away, and they don't want to be stuck holding your loan, so they'll make you buy insurance to protect them. Fortunately for you, once the equity in your house reaches 20%, once you have equity of $40,000 in this example, then you can cancel the PMI. You're not required to pay it anymore. I will note that often you need to notify your lender to cancel the PMI because they may not do it on your behalf. So you're going to have to be proactive when your home that you own now reaches 20% equity. All right, aside from that, next point, points. Points, interest points, what are they equal to? 1% of the total loan amount. Let me give you an example. Up here, our loan amount is $160,000. And let's say we are willing to pay 1%. So 1% of that loan is $1,600. Again, upfront costs. Well, why would we pay, oops, not 16, why would we pay an additional $1,600? And the answer is when you purchase points up front, or in other words, you put more money out for your mortgage lender, they're willing to reduce your interest rate a little bit, just a little bit. So for example, if your interest rate was 4.5% with 0 points, maybe it would be 4.35% if you purchased one point up front. Now, this can be pretty significant. In this example here, you already required 40,000 down payment. And if you didn't have 20% down, then you needed to pay for PMI. And then now if you have to buy an extra point, it's just another cost that you have to come up with up front. But that's what it is. And you could have 1 point or 2 points. Again, 2 points would cost you 2% of the loan or $3,200 here, but again, might reduce that rate slightly. Okay, moving on over on this page, we have loan origination fees. This is lender charging you fees to put together the loan. Everybody requires an appraisal fee. Now this is at a standard rate, but before your lender will give you a loan, they're going to ask you to have an appraisal. Let's say you buy a home and you agree on a deal with the realtor of $500,000, and then the appraiser comes in and they say, well, this house is only worth $400,000. Believe me, if the lender finds out that your property value isn't worth $500,000, they're not going to give you that loan. That's not going to happen. So appraisal is very important. You want to make sure that appraisal comes in at your purchase price or above, preferably above. Next, we have title on your home. Again, your home is going to have title documents that have your name and maybe a joint ownership name if you bought this with a spouse or a significant other. Home inspection, termite inspection. This is to check for things that don't show up when you walk through the house. So they may be more detailed things up in the attic or down in the basement. Something like black mold could show up. All of those types of things. Faulty pipes, faulty electrical. So you want to make sure you have a home inspection. And then commission. So realtors don't work for free. They need to make money. Now, fortunately, if you are the buyer of the property and you secure a realtor, that realtor is going to act on your behalf and spend enormous amounts of time looking for a home that suits your needs. Buyers will also help you with finding lenders, give you estimates, all kinds of services provided by a realtor for the buyer. And buyers, you don't have to pay for those services. The realtor provides those services because they want you to buy a house and they want to serve as your realtor. So those services come for free to you. On the other hand, seller's realtor, they help the seller get the house ready to sell. They set the price with the seller for the house and advertise. Lots of work on their part. And when the house finally sells, the realtor, the selling realtor, and the seller pay a commission. And then the two realtors, the buyer's realtor and the seller's realtor, split the commission and they each take a portion. But the commission is paid for by the seller of the home. So I always tell everybody, when you're in the market to buy a home, use a realtor. Buyers use realtors because they can do a lot of work for you and it won't cost you anything. And then if you never end up buying a home or something happens, well, that's the risk the realtor takes. That risk is not on you. All right, moving on. Let's talk about types of mortgages. Overall, the two major types of mortgages are a fixed rate mortgage and an adjustable rate mortgage. And with that, I want to pop over here to Bankrate. So I went into bankrate.com, website you're familiar with, and I want to look at right here mortgages. Maybe not. There we go. Here we go. We're going to look for a purchase. And I'm skipping over here to loan type. And all I'm going to do is pop down this down arrow. And we can look at some of the different mortgage types available. Conventional loans are here. 30-year, all the fixed rate mortgages. We have the 30-year fixed and the 15-year fixed. So what that means, very simply, is you will have the loan for 30 years. It is an installment loan. It has a beginning and an end. And over that 30-year duration, you will have the same interest rate and the same mortgage payment every month. So those are very popular loans. And if you think about today's interest rates being very low, it would make sense to secure your mortgage loan for the 30-year payment because that payment can't change. And yet outside of the mortgage, when the federal government decides to increase interest rates, the mortgage rates will go up, uh, definitely. So now is a good time. Mortgage rates are low. So if you're in the market to buy a house, it's a good time to secure a mortgage. But I'm going to go ahead and click on the 30-year fixed right here. And then our loan amount was $160,000. And we had a 20% down payment. So this was our loan amount. We didn't take any points. And even when I pop over here, I'm going to say our credit score is good. Our credit score is good. So I'm going to go for this maximum credit score. And let's see how much this will cost. Okay, so we can see that there's a number of different mortgages here on bankrate.com, and the prevailing rate looks to be around 4%. Yeah, probably on average around 4%. And that means our estimated monthly payment is right here, around $760, $750. And I bet you're thinking of that and going, oh my goodness, that's lower than my rent. And in some cases it is. But again, this payment is only part of the picture. In addition to this, when you have a mortgage, you have to buy mortgage insurance. So maybe that's another $50 to $75 on this house. And then you have to pay property taxes. And property taxes can be very high, about 1% of your loan. So now maybe 1.5% of your loan when all's said and done and you have all your local school costs, etc. So if we're looking at property taxes also, based on the value of our house, this was a $200,000 house, so our property taxes at a minimum are going to be $2,000, again, a year. Plus, it's probably going to be more. So when you look at that, $200,000 spread out over a year is another $150 a month that you need to add to this mortgage just to pay for your property taxes. So again, this isn't the whole picture. You have insurance and you have property taxes that need to be paid. But maybe even that, when you add that all up together, will be less than your rent. And on the flip side, this is an asset. Rent, unfortunately, is not an asset. But when you start building equity in a home, it falls on the asset side of the balance sheet and serves as an investment. So quite a few advantages of purchasing a home, but also quite a bit of cost that needs to be planned for carefully. Okay, fixed rate mortgage. Now I'm going to just change the loan type and I'm going to click on a 15-year mortgage. And look what we noticed. Instead of spreading the loan over 30 years, we've shortened it in half. Now we're only going to pay on that loan for 15 years. And at the end of 15 years, the house will be yours. The rates are lower. Now instead of 4, they're about 3.25%, significantly lower. Of course, the changing a 30-year to a 15-year increased the payment because now we have to pay off the mortgage over a shorter period of time. But the real question I want you to answer is, why does a lender offer a lower rate for a 15-year mortgage? 3.2. Why isn't it 4.0 like a 30-year mortgage? I want you to think about that for a minute and I'll come back to it. All right, I want to show you something else. Let's go here to now adjustable rate mortgages. Okay, adjustable rate mortgage, I picked the 5/1 ARM. What does that mean? Well, it means that for the first 5 years, the interest rate will remain fixed at this rate. These are not as good as 15-year, but they're not as high as 30-year. They're somewhere in between. But back up to the loan. Stay fixed for 5 years, and then every year after, that rate will adjust based on what's happening with interest rates in our economy. So we know now that interest rates are artificially low. I bet in 5 years interest rates will be higher than they are now. So you will enjoy this interest rates for 5 years, but right after that 5 year, those rates are going to go up, and they could go up significantly, which means your payment is going to go up as well. So when you plan for this payment and suddenly 5 years from now the payment has significantly increased, maybe even doubled, this is going to take a big bite out of your monthly income. These loans are a bit risky. These types of loans can really cause a family hardship when they adjust. Often, and I hope this doesn't happen very often, a lender will say, hey, you can go ahead and get a 5/1 ARM and your payment won't be as high as a 30-year fixed. And then in 5 years, you might be able to refinance, or at that time, you can refinance and get a 30-year fixed. But given what's going on today, that makes absolutely no sense. We know that interest rates are likely to be higher in 5 years, and that means the interest rates on fixed rate loans will be higher too. So yes, you enjoyed this rate for 5 years. That 6 year, this rate is highly likely to go up. And then the refinance would make sense because the fixed rate mortgage rate would be higher. And also, refinance does not come for free. It's in the thousands. It costs you maybe $2, $3, $4,000 to refinance your house. And again, that's money that has to come out of your pocket or that you have to add to your new refinance loan. Those are tough decisions to make. And while I'm not going to go into the detail of all of that in this class, I do want you to be aware that you need to do homework before you consider a type of loan like this and you consider a refi to reduce your rate. Some people think a 0.5% reduction in an interest rate is a good reason to refinance, and I don't support that. I think there are other things you can do to reduce the overall length of your mortgage rather than pay the upfront cost to refinance. Okay. So in the ARMs, we have 7 years fixed, and then back to fixed rate mortgages. And then there's VA mortgage, FHA, which are just different agencies who sponsor the mortgage. And I've given you more information on this worksheet that is in your weekly folder. I'm going to go back to the 30-year fixed right now and go back to our rates, which were about 4%. Now I'm going to change your credit score. I'm actually going to go to the 660 credit score over here, and let's see what happens. So instead of enjoying a 4% rate, your rate has just popped up to, well, not only has it popped up, but you've also lost significant lenders who are willing to lend to you. Rate's going to go up closer to 4.4%, and which means your mortgage payment is going to go up, and it will be up for the duration of 30 years. So bottom line, it's important that you increase your credit score as much as possible and wait until that time to secure your mortgage so that you can enjoy the best rate. There's some other versions of loans. Really, I want to stress that the most popular 30-year fixed rate mortgage. Next would be the whole category of adjustable rate mortgages. Now, I will say for investors, of real estate who are going to buy a house and fix it up and then turn around and sell it, then it makes sense to have an adjustable rate mortgage because you're not going to own the property for more than 5 years. Maybe you're going to only own it for 1 year. And then you would consider these. You're just going to go for the best rate possible, knowing well that you are going to turn around and sell the house in a short period of time. FHA loans, first time home buyer, these come with limits to purchase a home with a 5% down payment, for example, and they're in fixed and adjustable rate mortgages. And then VA loans for veterans. No doc loans are not common. Our reverse mortgage is, unfortunately, when you get into a situation, perhaps when you retire and you didn't save up enough assets for retirement, you can reverse mortgage your home and give your home up to another company, and then when you give it up, they agree to pay you monthly payments for a significant part of your retired life. Okay, subprime mortgages, again, big topic when we went through recession, but again, it's a mortgage for individuals who do not have a good credit score. And unfortunately, there were a lot of subprime mortgages issued that caused or helped support the cause of our housing crisis. And then refinancing I talked about earlier, and that would be when it makes sense. When you refinance because your interest rates have dropped significantly, or maybe you want to convert to a 15-year mortgage and you can get a better rate. Again, it has to be for really good reason because there's costs to refinance. I want to get back over here to this Excel spreadsheet. I just want you to understand something. So let's look at, I forgot to look at our payment. So we have our 30-year fixed. Let's go back and fix our credit because, we're well on our way to a very high credit score. So we're looking at a payment of about, let's say, $750. Okay, so our payment here then on our 30-year fix, so 30-year fix, our payment will be $750 per month. So then our total cost of loan, this is how we do it. We're going to take $750 and we pay that every month, so I'm going to multiply it times 12 months, and then I'm going to multiply it again times 30 years. That's the total cost of our loan. So for a $160,000 loan, when it's all said and done, I'm going to end up paying $270,000 for that loan payment over 30 years. Not quite double. Now remember, mortgage interest is part of itemized deductions on your tax return. So there is also a benefit. It's not a credit, it's a deduction. So the benefit is at your tax rate, but it is a benefit of owning a home. Pop back in here. I have to talk to you about now. I'm going to go back up to the top here, and I want to look at home equity loans. Last topic in this category is home equity loan. HELOC, home equity line of credit, is when you borrow against your home. So you have a home equity line of credit and a home equity loan, and the difference is the line of credit means that you have a credit that you can tap on, maybe up to $15,000. but you can use it. You might have a checkbook, or you can use it as needed. In other words, you don't have to use the whole $30,000 amount or the $15,000 and pay it back. You can use as needed. A home equity loan means you're taking out a fixed amount of money, 50,000, and you're going to take that entire amount of money up front and start paying it back over time. So again, this is more like an available line of credit that you can draw on, and your payments will be based on how much you've taken of the loan. And this one will be just a full out loan, and you'll start making payments as soon as you collect the money. So home equity loan line of credit, we're not going to use bad credit, we'll use excellent credit. And let's take a look at these rates. Say you're going to take out $30,000, still live in Sacramento, so let's find our rates. U.S. Bank 4.5%, and then one other. Not a whole lot listed here for home equity rates. This is what I want to talk about. So you have some equity in your home. What equity means is you have a mortgage of $160,000, and now your home is worth $300,000. So the difference between your home's value and your mortgage payment is equity. It's now what you have in your home. Great investment opportunity. Well, let's say now that you want to borrow against your home. You need money. Say you need $50,000. So you decide to borrow that $50,000 from a bank in the form of home equity. And the collateral you put up is your home. It's your home. You've just put your home as collateral, your major investment, so that you can get a $50,000 loan. Now, that can be great. It can be a great idea if the $50,000 is used for all the right reasons. So let's say you use the $50,000 and you add a bedroom to your house. Great. That just increased the value of your home. Let's say you are doing a complete kitchen remodel to update your kitchen. Again, that type of activity increases the value of your home. So that's $50,000 well spent. Now let's say you take out $50,000 because you have to pay off your credit cards. Wrong. That is a very bad use of home equity. You've just put your house on the line so you can pay off another debt, which doesn't make sense to me, and just is not a good way to think about using equity in your house. Often what happens is people are excited about this. Yes, I have a way that I can get out of debt. I can borrow against my house and I can pay it off. Unfortunately, what happens is often you pay off your debt, but you don't stop your bad practice, and then you're in debt again. And now you're in debt, plus you've financed, or you've taken out a loan against your house. The other things you do not want to take out home equity for would be to buy a car. A home equity loan is financed over 15 years. Can you imagine financing a car over 15 years? That just doesn't make sense. So not for cars, not for boats, not for vacations, and really not to pay off debt unless it's a last resort. Unless you've really had a change of heart about credit cards and you want to get out of debt, you want to start over, then maybe this can make sense, but that comes with caution. So I just have to bring that up because I don't want you to make any bad decisions about borrowing against your house in the future. Okay, I think that's about good enough for me to cover for home. You have a couple questions on your final quiz related to this, but if you listen to this carefully, I've covered everything, including the calculator. So when I ask you about a calculator on the test, I want you to come to Bankrate. And remember, there's a link here for calculators also, and there's one for home equity and there's one for mortgage. So make sure you use these calculators. Okay, thank you. Bye.